The government's disinvestment performance in FY25 is at a 11-year low. But before we jump to conclusions, let's break down why this might not be as bad as it seems. Since the 90s, the government has been selling stakes in public sector companies to raise money. This would reduce its reliance on taxes and the need to borrow money. But in FY25, the government has managed to raise just over 9,300 crores, the lowest in a decade. Why the dip? The word on the street is that due to the elections in May 2024, the government didn't want to anger voters by pushing privatization. And then the stock market took a hit, so selling their stake at a lower valuation would mean less money too. And as long as India's fiscal deficit is on track, it's okay. But there's one big reason why the government may not be too worried about its failure to push disinvestments, and that's to do with dividends. See, when PSUs make profits, they pay dividends to shareholders, and the government's stake means a steady cash flow without selling shares. In fact, dividends have already surpassed expectations by 4,000 crores this year, and next year the government's expecting a whopping 69,000 crores via dividends. Higher dividends could even attract more investors and boost the stock value. So when the government eventually sells shares, they could fetch a higher price. So the 11-year low in disinvestments, not such a bad thing after all.
Not bad, not bad.
The government's still getting the cash it needs, just through a different route. And in the end, everybody wins.